What's up, B2B fam? In this video, we're going to go over the top stocks for May 2024. This is super important because we're living in a very uncertain time. You'll see the Fed come in and say, okay, we're data dependent. We're not sure about lowering rates. I know when we started off, we thought we're going to get several rate cuts in 2024. Now it's looking like it may be one, but they're still predicting from the New York Fed a 58% chance of a recession. But the stock market was running like crazy last week, led by the tech sector. So in this video, we're going to dive deep into the numbers and actually look at the top stocks for this month based on the current wobbly market conditions. Let's get right into it. But before I forget, we're going to be talking about some key stock market terms. So if you want to understand what all these terms are so you can know the game and speak the language, click the link below for the key terms cheat sheet. If I was you, I would put it on my iPad or phone or print it out next to me with this video because I'm going to be explaining things like price to earnings ratios and earnings per share. And I'm going to be talking about why they matter for these particular picks, because remember, I want to teach you how to fish, even though we are talking about some individual stocks, so you can break that generational wealth curse. And the first stock is going to be Alphabet Inc., which is the parent company for Google. And we're going to go straight into some of the key metrics. So get your cheat sheet out if you don't have it. But the forward PE ratio is 20.9. So this indicates that it's high future growth expectations. That's mainly driven by its dominance in search, advertising, and cloud computing, which is killing it with AI right now, of course. The next thing we look at is the price to sales ratio. So this reflects strong investor confidence in the sales growth potential of Alphabet, obviously. And then the 3-year annualized revenue growth is 17.3%. That's going to show the huge growth, which is outperforming many peers in the tech sector. We can see versus industry, it's mostly green, right? They're beating the industry in almost everything. We look at Google, but it makes sense. They run everything. And if I'm looking at long-term stocks to invest in, like, you can't count out things like Google with the growth potential that it has behind it. Then we always want to dive into the EPS growth. That's at 12.5%. And of course, profitability is growing up above the industry average as well. But more importantly, when I dive into these things, I look at the debt to equity ratio. That very low debt to equity ratio of 0.09 shows me that Alphabet doesn't really have to rely on debt, and it's going to be a stable company. But duh, we could serve all their ads, they're crushing the game, they can finance their own activities. Another key metric is going to be that return on equity. 27.5% is where that's sitting. So when I look at the ROE, a high one like this, it demonstrates excellent efficiently in generating profits from our money. That's super important, right? Because we want them to take the equity that they get in and actually get a return on the profit. So when I'm breaking down companies and I see one that has a lower ROE, I may be like, ooh, I don't know about this one. Management or the structure may not be where we need it to be. Then, of course, in recent news, we know that it had a strong earnings beat of last quarter, and that was driven by the growth in cloud computing. They're doing their thing with Gemini, even though they had that kind of flop in the beginning, but it is getting stronger, and it's something that I've really been keeping my eye on because they're coming out with their multimodal AI to go against ChatGPT 4040 or whatever it's called. So they're right there in the game, and there's lots of future initiatives that are going to keep them at the top of the heap. And then we dive into analytics ratings. We see Alphabet is a buy with an average target price of 184.50. You got a couple different banks hitting that 200 mark. Google potentially getting to us at 177.89 at the time of recording. Remember, digital advertising is going to continue to explode, with the double-digit rates. They're going to continue to run search, YouTube. They got a stronghold in AI and cloud computing as well. So they have a super strong moat. And this is one of those stocks that's going to rock not only for May, but for going forward into the future as well. And of course, there's risk there because they have crazy competition in cloud computing with your Amazons and your OpenAIs and your Microsoft OpenAI combination. Then Apple's probably going to do something as well. Then you have the regulatory scrutiny over antitrust concerns. and a very strong dependence on digital advertising if some of these other things that they're trying to establish don't come to fruition. That's the only risk we see of Google, but I'm pretty bullish on it personally. All right, when we dive into Citigroup, we can see that the PE there is 18.99 against 16.6 in the industry. And I've been talking about my key term sheet. So if you have a look, and I'm talking about forward PE ratio or PE ratio, it measures if a stock is undervalued or overvalued relative to its future earnings. A high PE or price to earnings ratio indicates high future growth expectations. Low PE is undervaluation or lower growth prospects. Like this one is tricky because some people look at it to think if they're investing in value stocks, and others look at it to see how the company is actually over or undervalued. But it's super important to understand. That's why I put these key terms on here. Like I go deep. I even give you guys all the Greeks and stuff in the options, which we hadn't even talked about yet. This is a super important sheet to have in the link below. That 18.99 is just super strong and showing me that growth potential is good in Citigroup in the financial sector as a whole, of course. And then it's not on the screen, but I looked it up. The price to sales ratio is 1.6. That just shows that Citigroup could be cheap compared to its revenue, and it could be a value investment opportunity, but I need to go back and recheck that number. That's something that you guys can do here either on Yahoo Finance or I'm using Interactive Broker, but check that number to make sure, because I got a feeling with that latest PE, that number may be old. So double check that number, because I got a feeling it's probably up a little bit, because the PE is telling me that it's not undervalued. It's actually looking like it's lots of growth opportunities there. But when I look at my 3-year annualized revenue growth up to 2.6%, that's pretty modest, but that just shows that something is stable in a volatile market. Remember, when you're actually going in and investing in these things, you have to think about what your strategy is. You're like, okay, and do I want some crazy growth stuff? Well, if you want the growth, you're going to have to take on risk as well. If you want something stable, you may not see crazy revenue growth, but you won't see crazy dips as well. So it's all about how you play in that game. I'll actually include a link to a quiz below that you can actually do to find out what type of investor you are by answering 5 different questions. And then when I dive down and look at a EPS growth of 3.5%, well, that showed me that it's improving, but just a little bit slower. But remember, it's a stable stock. It's not a crazy growth stock. So this is something that you want in your back pocket if you're looking for stability in any market in the financial sector. And then the debt to equity ratio is going to be 1.15. Then when I look at a debt to equity ratio of 1.15, that's going to let a bit high for me. It shows that they're using a lot of debt, which can be risky, but it is a bank. So banks are all about debt, but I'd have to dig deeper into the financials to find out what that really means for this particular company, but I'm not surprised. A more important one to look at is going to be ROE, or return on equity. Remember, that shows what they're doing with the money that we're investing in the company. And as you can see, there's decent profitabilities on ROE sitting at 8.5% as of the recording. And when you look at recent news, it talked about restructuring to improve their profitability. They're going to go to digital banking like everybody else. And if you're over to the analyst ratings, they say it is a buy with a target of $66, currently sitting at $64. And this is one I put on the list because I like it out of all the other financial stocks, but interest rates, of course, are going to play a big factor in something like Citigroup because it depends on what happens with those rates. So, of course, rising interest rates are going to be beneficial for the bank, but low ones are okay as well. So it's pretty stable. And then Citigroup focuses on a global market to provide that diversification. Fun story, when I actually was stationed overseas in Japan back almost 20 years ago, man, I'm feeling old. Citigroup was the only bank I could find when I was out in Tokyo to actually get funds in and out without fees. So I used Citi a lot when I lived over there, and that just shows you the international foothold that they have, and that's a great moat or diversification for us. But of course, you got JP Morgan Chase and Bank of America as key competitors to Citigroup. And then being that it is financials, there's exposure to the global economic fluctuations. Of course, any regulatory changes are going to affect the banking sector. So you really have to pay attention. And we know things wouldn't be complete without a fintech play or financial technology stock to actually look at in the top stocks. So this one is called Fidelity National Information Services. That's a mouthful, pause. But if I jump over to these guys, we can quickly see that Fidelity, their acronym FNIS, I don't want to say all that. These guys, FIS, is a provider of financial services, technology solutions for banks, businesses, and developers, right? So long story short, they're a fintech play. They provide financial technology for banks and big businesses on the corporate level. One thing that I really like about FIS is this: 97.74% institutionally owned. So my friends, this is what we call a smart money play. The smart money is in Fidelity National Information Services. So we should be too, not financial advice. But if we dig into this, we can start to see more things that are interesting to us when we look at those key ratios and some of those key terms that are on that sheet you're probably looking at. So when I look at this PE here, it's 108. Keep in mind, like Google was like in the 20s. It's nuts. And remember, this price to earnings ratio is just going to let me know if something is under or over valued. But holy cow, like just recently, they've been at a 52-week high. That 52-week high over here is super important, right? And it ties directly into that PE. Look at this. The 52-week low was $46.50. The 52-week high was $78.56, which makes perfect sense now when I see a PE ratio of freaking 108, which is insane. So I'd have to dig deeper to really understand if this is over or undervalued, or the market could be just expecting crazy growth in the financial technology services sector. But wow, like 108's insane. Like we can go in, and this is another thing that's not on the key term sheet, but if you look at the RSI, it can give you a little bit more information as well to try to find out if a stock is under an or overvalued. You can tie it in with the PE ratio. But let's not get caught up on that big number, but it's pretty crazy. But it's super interesting because annualized growth is down. But you got to understand about technology companies is that they burn tons of money. It has a lot to do with that compute power that we talked about before. Like server space is super expensive. Like how much is it for 2 terabytes of iCloud again? Now times that times 1,000 and see what those bills actually come out to be. So actually growth hurts technology companies, which is a whole other topic, but it's something to pay attention to when you're looking at balance sheets and you're like, oh, they're not making money. It's more so looking at who the management is and the investors in their plan for profitability and growth. You're looking at the earnings per share, like it's going to be decreasing as well. If I'm being honest, you really be looking at this one, just really trying to capitalize off the crazy projected growth. So with that being said, this one is a little bit more risky. Their debt to earnings ratio is okay. Last time I checked, it was at 0.42. So it's not bad. Like they're doing okay with managing their debt. So that will be a huge red flag if they were deep into debt and not making as much money because they are a tech company and have a lot of burn. I'd be worried about that. And then one thing that does give me pause is that their ROE is pretty low. It hasn't been great, but there's been some huge partnerships with digital payment solutions and some strategic investments to kind of streamline those operations. But the bottom line for FIS is there's a lot of competitors like Rocket Money and Robinhood and Futu and Into, and their moat is pretty narrow. So honestly, I'd be in and out of this one, trying to capitalize off some of those moves if I dig into the charts. And if I can look at supply and demand levels, I would snipe in on this one. But it's good to really see this one because you can be like, okay, now you can start to understand those numbers and measure it against things like your Googles and your Citigroups that are a lot more stable and see that, oh, this may be a bit rocky. So if somebody tells you, oh, let's invest in FIS right now, understand why, that it is a short-term opportunity. Of course, we got the analyst rated saying buy with a target of $78. Is at 78. It's not 78 right now, and they're saying 78.61 is the target. There's a high target of 85. You should hold at 75. So like I said, it's pretty tight on this one. So I wouldn't really be going too crazy, but I am tracking it for this month, and I'll give you updates if anything happens with it. Another thing that makes this one super tricky is that it's actually trying to compete with PayPal and Square, and I guess Cash App. I'm pretty sure Square owns Cash App. So some of those other payment solutions on a broader scale, they are targeting bigger institutions and banks and professional services, but so does PayPal and Square. So that It's a scary thing and it gives me pause. And it's why I said this is a short-term opportunity. So I hope you're understanding all this information as I kind of dive in deep and show you some of the things that I look at to determine if something's a longer-term opportunity or a short-term opportunity. All right, now, of course, we're going to dive right into the healthcare space and look at Intuitive Surgical. So I want to actually start off looking at the 52-week high and low, like 254 is a low and 403. So this bad boy has been running and they are the leader in robotic surgery. So that's for a good reason. But let's jump into some of the other metrics that we have here. So going straight to this PE, we see we got 71.54%. And hopefully by this point, I'm sounding like a broken record because that means you're actually learning something. But a high ratio of 71.54 means that there is strong growth expectations due to this being a leader in robotic surgery. So this is super awesome. This is something, when I looked at the actual data and key ratios, it looked a lot better than the previous stock that we talked about. And this is something that I just discovered recently, so I'm sharing it with you guys. And when I look at my price to sales here at 18.7 last time I checked, it shows that there's a high market valuation of its sales, which shows a lot of investor confidence, and there is a lot of institutional investors in this bad boy as well. You got 3-year annualized returns of 17.1%, so that's also a high growth rate, showing that the business is strong like bull. We love that. Same story with EPS is looking great, meaning this is a profitable company. And as you know, everything medical is super expensive. So of course it is. Debt to equity is crazy low at 0.02. So that's minimal reliance on debt, letting you know that it is a rock solid, stable company here as well. Return on equity last time I checked was 25%, showing that it's going to be efficient management and very profitable. So I am loving everything that I see from Intuitive Surgical Incorporated, because remember, this is a company that's doing those robot surgeries. So this stuff is the future. Like, that's why I'm so excited about tech. So if you look at it, I know there's probably somebody watching this video that probably either had robotic surgery, maybe you hadn't had it yourself. You know somebody who's had robotic surgery, but this is the future, right? And if it's robots, that means that AI can kind of do it, and it kind of ties into some of the other stuff that we've been talking about on the channel. So there is a strong moat for this company. Remember when I talk about a moat, that's like a competitive advantage over others because they are the leader in this robotic surgery situation, which is terrifying when I think about it. If I was a patient laying down, but hey, maybe I do trust robots more than humans. They can't go out and have all night benders or be thinking about fixing up their cars while they're trying to do surgery. Like I remember when my son was born, freaking doctor was asking me questions as a resident American in Australia about Donald Trump and talking about golf while he like hit my wife cut over trying to get my son. I'm like, focus, bro, focus. We can see that this company has a buy rating here, which right? And it's been expected to outperform and being a bit overweight by others than hold. It's very mixed on this one, but when I look at the actual data, like I really, really like this stock, and these institutional investors are awesome as well. Of course, there's going to be some other competitors, but I feel like by market cap, this company is really beating the pants off the other competitors right now. So I am not mad at this opportunity at all. Remember, it's great because even though I'm talking about the top stocks for May, we're diversifying ourselves around healthcare and fintech and financials and big players like Google and with AI and cloud computing. We know diversification is key. And if you're curious about what type of investor you are, there's a little quiz down below that you can quickly take. It'll take you like a couple minutes, maybe 2 minutes to fill the quiz out. And it'll let you know what type of investor you are, so you can make those informed decisions. Because I get the questions all the time, like, what should I do? I'm like, it depends. This quiz will help you tick off that depends. You can say, okay, I am a aggressive investor based on this, or I'm conservative or balanced based on X, Y, and Z. But click the link below to check the quiz out. All right, now I'm going to show you an example of a super stable and boring company. We're about to talk about Ketchup, y'all. Yes, the Kraft Heinz Company, or KHC, not KFC, KHC is what we're looking at now. Kraft Heinz Company jumping in, and look at the PE here. Remember, we're seeing like 100s and 70s and 50s. Well, 15.75 for Kraft Heinz. But remember, we're not expecting crazy growth out of ketchup? Like how can you innovate on ketchup, mustard, and whatever the hell else Kraft makes? It's ketchup. I'm not even go through these metrics because we understand it is what it is when it comes to Kraft Heinz. But the reason that I really care about this one is just a pure dividend play. You got a good, nice dividend. It's going to get paid on time. And this is just one of those I wanted to just show as the kind of antithesis to some of the growth ones that we all look at and get excited about. These metrics here are a far cry from what we're seeing with Google and some of the others and Spotify, which we'll look at on another video. Super boring stuff. And if I look at their debt to equity ratio, pretty balanced. They have manageable debt levels, return on equity. It's not great efficiencies in the business of making ketchup. It's still 6%, but I ain't mad at them. I know it's super stable. Keep in mind, of course, they're talking about new products, focusing on health conscious consumers and continuing to do cost cutting to improve margins as well. Like the analyst ratings on this one says buy, but honestly, like I would call it a hold if you got it. And if you look at the targets here, target at 39 is currently chilling, sitting at 36. Like it's not exciting. It's not doing nothing crazy. We're not going to go crazy with ketchup, but I like showing you these because you may be a conservative investor and you may be like, you know what? I'm happy with ketchup. I'll just do more research on the dividends and I know that ketchup's going to keep squeezing out those dividends. I should put a laugh track in. Had to throw that dad joke in there. I got the dad vest on, so why not? But we know ketchup is going to keep producing dividends and keeping things nice and chill. So there you have it. That's 4 or 5 stocks that I've broken down for you. But the key thing is to show you how to fish. And that's why I put that quiz to tell you what type of investor you are and that key term sheet that you should already have downloaded while you're watching this video in the link below so you can follow along, because I want you to learn and see the difference between different stocks and their purposes. So when you're watching my video or anybody else's and we're talking about, I'm super excited about Palantir or Spotify or Nvidia, those earnings are coming up in a couple of days, by the way. Of course, the market is expecting them to totally blow out the earnings, and why not? They're the leader. Everybody needs microchips. They're the future, right? Crushing it there, and they're building that mode up, but there is competition coming from your likes of Google, Microsoft, Amazon, so on and so forth. Apple even has some stuff they're going to talk about, but I think they're going to be doing more partnerships. But this is not an NVIDIA video. I could do this stuff all day because I love really getting into the weeds. And if you're a SpongeBob SquarePants watching, low attention having person, you probably already bounced out on this video. But for all my OGs who stayed, I really appreciate it. We are here to break those financial wealth curses, and you're not going to get that in a 1 or 5 minute video. You got to buckle in and take notes with me, because what we're trying to do here in the Broke to Breakthrough community is leave more for our families than just debt than we die. And I'm your boy Michael T. Ragland. I am out. Until next time, B2B fam. Peace.